Hi folks, welcome to this video on your quiz. In this quiz you were asked to prepare a consolidated balance sheet at acquisition using the entity theory, and then in the second part we did ask you to do some calculations for NCI and goodwill, assuming that they would have used the parent company extension theory. So presumably you have your question in front of you or you recall it, but I asked you to make an entry at the date of acquisition to record the acquisition of the investment on the parent company's books. So what did we do? We debit the investment in the sub CView for the value of that investment, $31,500. We're also going to book the professional fees expense. Don't forget there were some costs associated with doing our deal, and those costs are sunk costs. So you remember when we talked about acquisition costs for the investment, back when we discussed business combinations in a much earlier chapter, we talked about this concept. So those fees would be expensed, and we'll credit cash $32,500. Now, don't forget, in the question that you had, they gave you this separate entity balance sheets at the day before this acquisition took place. So you're going to have to make sure that you adjust your cash when you do your consolidated balance sheet to remove or to adjust the consolidated balance you're calculating by $32,500 downward in order to get the correct amount of cash in the consolidated balance sheet. So anyway, we'll talk about that in a moment. Next thing I asked you to do is to calculate the acquisition differential, goodwill, and NCI, again using the entity theory. So again, what we do is because we as the parent, only bought 90% of the outstanding voting or common shares, we paid $31,500 to get that 90%. Now, don't forget, we only bought 90%, but we control 100% of the investment. So the implied value of 100% is $35,000. We're going to compare that $35,000, which is the fair value of the investment, to its carrying value and any fair value increments that we as the parent assessed in order to come up with that purchase price of $31,500. So now, to get the carrying value of CView, the sub, we're going to take the common shares plus the retained earnings, which you'll remember, the retained earnings of CView was a deficit. All that means is that the retained earnings is in a debit balance. So common shares are credit plus a debit, which is why I have brackets, is going to give us carrying value of the sub at the date of acquisition of $25,000. Now, if you wanted to, you could have also done a calculation of assets less liabilities, because again, we did give you the balance sheets at the date the two became related, right? Which is, I think, on June the 29th. They became related on the 30th, but you could still take, at the date they became related, the carrying values of all of the assets and liabilities on the sub-separate entity balance sheet, and you would still come up with $25,000. But you can calculate that yourself if you wish. So the difference between the implied value of 100% and the book value that you now control of $25,000 is going to give you your acquisition differential, which is $10,000. And I now have to allocate that acquisition differential. How? I'm going to allocate some to my inventory increment, which I saw from the example I was given. I compare the fair value to the carrying value, and fair value is $1,250 more than carrying. Plant assets, similarly. The plant assets had a fair value which exceeded the book value by $87.50, and my intangible assets, their fair value exceeded book value by $2,500. So on that side I have $12,500, but don't forget I also have the long-term debt. Now the long-term debt, the fair value of that debt was actually less than the carrying value, but to me that's a good thing, because I picked up less debt from a consolidated perspective as the parent, right? So I've got an increment there of $5,000 that I'm going to add to the $12,500 to get $17,500 of extra value that I assessed over and above the carrying values of the sub. So if I take the acquisition differential and deduct the total of fair value increments and decrements, I'm going to get negative goodwill. So some of you had a problem with this. You're going to take your acquisition differential and deduct your fair value increments or decrements that you got, right? In order to get your $7,500, which is a negative number. All right. So now all I said here is that goodwill is not going to show up in the consolidated balance sheet, because what happens? We learned in this chapter that any negative goodwill is recognized by P as a gain on its separate entity income statement, right? So I don't book any negative goodwill in the consolidated statement. That was another error some of you made. Some of you took the goodwill onto the consolidated statement and made it negative. So good for you for calculating negative goodwill, but again, it gets allocated to the parent's income. So therefore, we don't have any goodwill in the consolidated statement. So that's why some of you may have balanced to the wrong number. Now, when you're calculating NCI, don't forget again, NCI, under the entity theory, gets its share of the implied value. It includes the negative goodwill. So therefore, NCI is going to be $3,500. All right. So now, if we were to do the entry on the consolidation worksheet at the date in order to set up all of our increments, including our non-controlling interest, don't forget, we're doing the consolidated statements for the benefit of the parent shareholders. They don't want to see the common shares of the sub, nor do they want to see the retained earnings of the sub. They only want to see the common shares and retained earnings of the parent on the consolidated balance sheet because they're shareholders in the parent. Again, we're going to set up all of our increments for inventory, plant assets, and intangible assets, just as we assess them here up above. And don't forget, our long-term debt was reduced. The fair value is less than carrying value. Because it's debt, it means that we're going to be carrying less debt from the sub on the consolidated balance sheet. So we debit it for $5,000. Now, tricky part here. We set up here when we were looking at the negative goodwill, we said it gets recognized into the parent's income. But don't forget, we're doing the balance sheet at the date they became related. If we're using numbers that are related to their separate entity balance sheets at the date they became related, which is June the 30th, we have to remember that on the date that we're doing our consolidated statements, the two separate entities, parent and sub, must have already closed their books and have their own separate entity statements already prepared. So in other words, you can't do consolidated statements until the separate entities have done all their separate entity statements. And that includes the closing process that P would go through as well as S. So when P closed out that gain of $7,500, they would have closed it out to the retained earnings. So you need to make sure that on the consolidated worksheet, we pick that up going into the retained earnings of the parent, right? We have our NCI that we're going to set up. And don't forget, because we're picking up carrying value of the parent or the sub plus all the fair values, that really as well as the NCI, that gives us the value of the investment in the sub, right? So by definition, we're not going to double count the investment, because when we add carrying value, the sub plus the fair value increments that we assessed because of our relationship with the sub, those in total would give us the investment account. So we can't double count, so we eliminate the investment so it doesn't show up in the consolidated statements. So now we have to go ahead and we have to do the consolidated balance sheet. Well, like I said earlier, we're picking up all of the carrying value of the sub, all of the carrying value amounts, right, which I'm highlighting for you here, right, all the carrying values, and we're picking up any of the fair value increments here, which are bolded in black, right, bolded in black. I bolded this guy because that's the negative goodwill that got closed out to the retained earnings of the parent. Don't forget, we only have the retained earnings of the parent at June the 29th. This would have got done after June the 29th, so we have to add it into the retained earnings of the parent, because they would have this on their separate entity balance sheet on June the 30th after they closed out their separate entity income statement. So this is what would be sitting technically on as part of the retained earnings balance, okay, of the parent. So we pick that up, right? Now, these items in red are what? Well, these items, that was the amount that we paid. All right, that was the amount that we paid on June the 30th when we did our deal, right? We paid $1,000 in professional fees, and we also paid cash, and that included the value of the investment, right, that we paid for in cash. So that was $32,500. Don't forget, this entry here was done on June the 30th. right? These numbers are June the 29th numbers, so we got to deduct that. Don't forget our carrying values plus our increments are all set up, and again that justifies why we don't have the investment in the sub account, because we're picking up all the carrying values plus the increments, and that's equivalent to the fair value, right, under the acquisition method. Again, here we are picking up carrying value, but the fair value is a decrement. So again, well, meaning, and I deducted it because we had our $5,000, but I'm deducting it because again, we being the parent, thought that the long-term debt of the sub was only valued at 32.5, not 37.5, and we as the parent are going to pick up 32.5, the fair value, right? Exactly. So we're only picking up again the common shares of the parent again, and we don't notice here we don't have the retained earnings of the sub. Now some of you, what you did is you deducted the $13,750 as the deficit and then added it back to get, as you would have done here, right? Which is fine because that would have still been zero. But what I was looking for was to see that you guys had included the amount that the parent would have closed out to its income statement for the negative goodwill, and picked it up on the retained earnings, this parent's retained earnings, because that would have increased the retained earnings by the time you got to June 30th, right? And again, don't forget here that we also would have closed out the expenses, right? So don't forget, this is what Pacific, the parent, did on its books. That guy, by the time you do consolidated statements, you have to have your own statements up to date, right? So you would have closed that expense out to retained earnings, right? So that's why we deducted it here. So we've got 82,750. So your balance sheet should have balanced to 405. Now a few of you got that, which was great. Some of you were off by the amount of the goodwill because some of you included goodwill in here as negative. So it threw your numbers off a bit. But you still did okay. You still did fine. Now, if we were using the parent company extension theory, don't forget, under the PCE theory, those theorists don't believe in the calculation of goodwill as we've laid it out. These guys would say, well, we don't know that the implied value of 100%, what you would have paid for 100%, is just a linear extrapolation. So in other words, you can't assume under parent company extension theory that just because you paid 31.5 for 90%, you would have paid 35,000 for 100. They don't believe that. And because they know that under the entity theory, NCI gets its share of that implied value, those parent company extension theorists don't allocate any of the goodwill to the NCI. So the NCI is only going to pick up its share of the carrying value plus the fair value increments. It's not picking up its share of the negative goodwill. So here, when we calculate the NCI, we're only picking up our share of the NCI is only being allocated its share of the carrying value of the parent of the sub plus the fair value increments. At 10% is 42.50. Negative goodwill, you only pick up P share. Again, you don't allocate NCI its share of goodwill at all on the consolidated statements, so we only take P share there. And because we calculated negative 7,500, we would only pick up negative 6750 under PCE. That's what our negative goodwill calculation would be. Now, before I close off this problem, I wanted to explain something to you folks because there was a little bit of a problem doing the parent company extension theory. So I thought it might be useful to do a little bit of a document here that asks you to remember the rectangle that we talked about. Remember, we said in an earlier chapter that the fair value of the investment, which is 35,000, that's the fair value of the whole thing, would be equal to what? The carrying value of the sub, okay, plus any of the increments, that's 42.5, plus your goodwill. But at this point, your goodwill's negative. So these three little fellas here always add up to the fair value of the investment. If the goodwill was positive, I just wouldn't have brackets, right? And I'd have a different value for the fair value of the investment. But in our case, you can see how the fair value of the investment can be broken down at any time. The carrying value of the sub plus the fair value increments plus any goodwill that we purchased at acquisition. So that's the fair value of the investment at the date we became related. Right? So now under the entity theory, what we would say is, well, they're getting their full share, which includes the negative goodwill, because again, these three guys add up to 35,000. So they get 10% of 35,000, and that's 3,500. But don't forget, under the PCE theory, we don't allocate them their share of goodwill, even if it's negative. So now they're getting their share of a 25,000 carrying value of the sub, plus the fair value increments and decrements that we've assessed on the sub's assets and liabilities that are identifiable. So that's 4,250. So I thought it might just be a good idea to remind you of the rectangle so that you remember that NCI gets its share of the fair value of the investment under the entity theory, right? Which includes goodwill, which in this case happens to be negative. But under PCE, they only get their share of these two guys, not any goodwill. Whether that goodwill is negative or positive doesn't matter. Okay, so you heard my phone ring there, right? Anyway, no problem. So that's all I wanted to remind you of. And in fact, one of the things you'll notice here, and we talked about it once in class, is that under the entity theory, because NCI, when there's negative goodwill, the amount of NCI or fair value that they take on in the company, right? Their value that's allocated to them, the parent of the fair value of the company, is actually less under the entity theory than it is under the PCE theory. Why? Because don't forget, these guys are also getting their share of 35,000, which includes negative goodwill. It's negative. If this goodwill was positive, this NCI under the entity theory would be bigger than under the PCE theory. But the PCE theory, it's bigger because we're not allocating them their share of a negative number, which is negative goodwill. Okay? So I think that concludes pretty much our video on the quiz. If you have any questions, certainly send me a note. If you're in my class, you have my email. If you're not, I'm hoping that you found this video of help. And even if you are in my class, I hope you found it of help. And I hope you guys have a great day. And thanks for listening.